Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the 37th episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, there's a ton of stuff going on, but I do want to take a second here. We're recording this on June 6th, so D-Day. I was reading a little bit about it, obviously. Thanks to so many people, right? 97% of the soldiers in that first wave gave their lives to protect people they probably were never going to meet, people whose language they didn't speak, and really make a lot of our lives better, along with Memorial Day, which was recent as well. I mean, you like movies. Obviously, you know where I'm going with this. Saving Private Ryan, that intro, Sonu, I don't think there's any more powerful intro to a movie, is there?
No, it's sort of seared in your head. I mean, I was reading about D-Day as well after he spoke, and one thing that always still amazes me, how they managed to keep it a secret over 2 years.
Yeah.
Because, like, how do you keep something like this a secret, like, for 2 whole years? And, yeah.
Maybe you don't have social media. Maybe that's how they pulled it off.
There you go.
Not to be funny, but I mean, yeah. So definitely thinking of people there. And Sonu, also for the YouTube channel, I've got my Y charts hat on. Actually, I can't put my Y chart. I've got. I just realized I've got. If you can see this, I've got headphones on. I just tried to put a hat on over my headphones. That didn't work. But just so everyone knows, on the 15th,
one of those wide-brimmed sombrero type hats. I mean, that's what Y charts needs to get.
That's what I need. There we go. But I'm doing a real special webinar with Y charts on the 15th of this month. So that's next Thursday. I'm going to talk a little bit about Sell and May Go Away and just some different other things that we're seeing. And honestly, if you listen to this podcast, you might have a clue what we're going to talk about. But definitely be sure to check that out and sign up for it. You can sign up for it on Y Chart social media, wherever my social medias are. I know Carson Group is also going to be sharing it as well on social media. So definitely check that out. We want to promote it, and it should be a lot of fun. All right, Sonu. So this is the 37th episode. It feels like a minute. We recorded some of the previous couple of weeks. We had the Ron one previously recorded. We had Libby on recently, but it feels like a while. But we're just going to jump on the bike and get rolling here. 3 things we want to talk about, because we're just going to get up to date on things. Stocks, the economy, and the Fed. Those are 3 things we talk about a lot. And by the way, we are titling this one, Bears, You Are Not Serious People. Now, if you know where that's coming from, we're going to talk a little succession as well. And believe me, we are going to talk about the ending, and I will fully give a disclaimer. Just fast forward for 3 minutes. We're going to start a clock. We'll talk about it for 3 minutes. You can just skip this if you haven't seen the show or haven't seen the finale. But honestly, if you haven't seen it by now, shame on you, because that's my take on that. But a little play on Logan Roy's comment to his children about not being serious people. We're going to kind of take the look at the Bears and some of the things they're looking at, but the things we see that are positive on the economy, stocks, and then potentially with Fed policy. All right, Sonu, one more thing to talk about. I've heard of, virtual reality. Now we have augmented reality after yesterday with Apple. Are you going to buy that $3,500 goggle thing? Can you imagine putting a hat on wearing that goggle thing? I don't know. What do you think of that?
I saw the video and I was like, this thing is amazing, because a lot of these other virtual reality sets, you put it on and then you're like, oh my God, I hope I don't run into a wall here. Right. But
right.
So this looks amazing. And then, you see the price and like, goodness, okay, maybe I'll wait a bit before, maybe wait a decade or something by the time it comes down to the price of, like when normal people can buy it, I suppose. But I could totally see, I mean, sitting in an airplane watching, I don't know, Rocky on a 120, 200-inch screen, not having to worry about what's around you. Except when they come for pretzels, it's augmented reality. So you can actually have a conversation saying, yes, I want pretzels and a Diet Coke or whatever it is. Right? So.
Maybe someone punches you in your shoulder to get your attention. You really feel like you're in Rocky or something, That's Ivan Drago hitting you there. I think like a day or two before Meta just released theirs. So this is definitely a new wave of things. And I fly around a lot. I get to visit people all over the country. And I have those Bose quiet, the quiet blocking. You put them in, and it's just like whoop, and I don't hear anything. So I like those. So maybe someday I'm not
Maybe
I'm not going to
Carson.
get this one right away.
Maybe Carson may get you one. Who knows?
Ooh, dropping some hints here. There we go.
Get us
All
one.
right, there we go. So let's that's good stuff. So, and by the way, so Apple did hit an all-time high, then it did sell off, and maybe sell the news, or who knows exactly. Apple's been such a strong stock. We've talked about it before, but did hit all-time highs the day or the second that release came out, and then sold off a little bit. But we'll see what happens with that. But so let's start with the economy. You're going to talk a lot here. I'll chime in. There's so many places to take it, but as you've laid out, I think rather correctly, since really November of last year, you did not see a recession coming. Now we're getting data that's really confirming that. A lot of people are agreeing, punting, their time of the recession, when it'll start, realizing that, there's no soft landing, there's no hard landing, there's no landing. We've got plenty of fuel still in the plane. We're still flying around. So I guess we can start with the jobs number. I wrote down jobs, consumption, durable goods, and construction spending. Those are the things I wanted to hit on. I know you've talked about them. We can go other routes if you want. But let's start with that jobs number, what it meant to you.
Look, payrolls came out. People are expecting 189,000, 190,000 thereabouts jobs created in May, right? Yep. And then payrolls, again, I'm laughing. I mean, come on, people, you cannot be serious, right? Getting to the title of this episode. 14 payrolls are beating expectations, 14 straight months. Come on. I mean, at some point, it just tells you how much this economy has been underestimated, right?
Yes.
And payrolls came in at 339,000. Massive, massive, massive beat. And by the way, March and April were also revised higher by about 93,000 jobs. And then you get 339 on top of that. Come on. The economy's created 1.5 million jobs over 5 months. And job growth, led by industries across the board, right? Right now, what's boosting it? Healthcare, education, government, right? They didn't participate in the early recovery, but even cyclicals, you think about leisure and hospitality, retail, transportation, warehousing, construction. We're going to talk more about construction. All of them gain jobs, right? Manufacturing is low, but even there within the auto sector, you're talking about durable goods, right? And, that's coming back. The auto sector gained about 7,000 jobs. Now, for a recession, you have to think, okay, how is a recession going to play out, right? People talk about, we're going to get a recession because the yield curve is inverted. We're going to get a recession because M2. I don't know, Ryan, if you've seen the latest thing about the Treasury General account, Treasury needing to issue bills because, they ran down their general account at the Fed because of the debt ceiling thing. They got to replenish that. That's going to drain liquidity. That's the next big thing, right? But look, at the end of the day, you have to say, okay, for a recession to take place, what sector of the economy slows? Okay, you think about cyclical sectors. But for the cyclical sectors to overcome the momentum in places like healthcare, education, government, even leisure and hospitality, right? You have to lose a massive number of jobs, huge number, right? So again, come on, at some point we have to say, don't listen to those folks saying we are in the middle of a recession or we're close to one.
I can't disagree with you. I mean, so one other highlight, prime age workers. Those are, what is that, 24 to 55, I think, Sonu? Yeah. What is the prime age? That's close enough for government work. 80.7%, near the highest level. Yeah, that's like the highest level in multi-decades. So you hear the thing about people don't want to work or people are getting laid off at large companies. Yeah, some of those highlights, or maybe lowlights, depending on what side you're on, earlier this year from large companies, the tech companies that grew so much, did lay off some workers, very small percentage of the overall workforce. But still, almost 81% of prime age workers are working, highest in over 2 decades. That doesn't sound like people aren't working. But Sonu, the one final comment on this. So the employment continues to surprise the upside. The unemployment rate, though, jumped from 3.4 to 3.7. The highest number, if I can read my writing, that's the biggest jump, I think, since November 2010 in terms of 1 month.
Yes.
So, that's one potential worrisome sign, isn't it, that unemployment spiked? Or what's your take there?
Yes. There's always something, right? And look, I won't spend too much time with this, but so the payroll data, what we just quoted, right, 339,000, that comes from what's called the Establishment Survey. So the Bureau of Labor Statistics asks about 150,000 businesses, how many people they hired, right? And that's where that number comes from. Now, the unemployment rate comes from something called the Household Survey. And this is a survey in which the BLS, the Bureau of Labor Statistics, asks households, about 60,000 of them, about their employment status, right? Now, obviously, it's a smaller survey. It's very noisy, right? It's good for ratios, things like the unemployment rate, and you just talk about the employment population ratio. Now, what happened was, because they ask households about their employment status, they also count people who are self-employed. And turns out, remember, this is a very noisy survey. Something really quirky happened in May. About 300,000 people got unemployed in May. So that's why the unemployment rate went up, right?
Okay.
But the number of self-employed workers went down by about more than 400,000, right? So what happened to self-employment, if just taking a longer term trend? After the pandemic, self-employment surged. A lot of people doing gig work, things like that, food deliveries, whatnot, right? Now that's normalizing. So I think a lot of workers may be quitting gig work and going to, quote unquote, the relative safety of, getting a W-2, right? And of course, that tells you something about, it's probably easier to get that sort of a job now because it's a very good job market, right? Again, look, the household survey is a very noisy one, so I don't want to make too much out of this. But going back to your point about the employment pay population ratio, it's like the opposite of the unemployment rate. And then if you look at it for prime age workers, which is 25 to 54, as you mentioned, Ryan, that's at 80.7%. That's still higher than at any point between 2001 and 2022, right? That's the opposite of when people tell you, oh, nobody wants to work, we can't find workers. No. We have the highest number of people, in their prime working age, working as percent of the population. That's huge. This is the best labor market since the late 90s, dare I say.
No, that's great stuff there. And a continuation of this conversation is if you have a strong employment backdrop, you have people working, you have better consumption. Just last week, we had personal consumption came in up 0.8% versus expected up 0.4%, the biggest jump since January. Real personal consumption also, so that's looking at inflation, was up 0.5% versus up 0.3%. You've talked a lot about this, and I think one of the main reasons, probably not to put words in your mouth, but you didn't expect a recession this year. Yes, housing was troublesome. Manufacturing potentially troublesome, but you said the consumer is 2/3 of the economy. Consumer is still strong. Last week's data does little to change that. Now, Sonu talked. Well, here's what I want to ask you: relative to inflation, we're making more money. That's a good thing, right?
Hey, nobody can complain about that. And look, relative to inflation, you think about what's coming down, right? Inflation's coming down. We're going to talk about the Fed, but inflation's come down from about 9% to about 5%, 4.5%, something like that. And a big driver of that has been lower energy prices. Lower food prices. Food prices are finally falling, groceries and things like that. Remember egg prices? That's down now.
Oh, yeah.
So it basically means there's more money in people's wallets, right? And what are they doing with it? Americans famously don't save enough. We all know that, hear that. And Americans don't save zero. So let me make that clear, right? It's not, we save for 401ks, things like that. So you have to dig behind the statistics for that. But consumption's increasing because incomes are going up, and incomes are going up because people have, the cost of food and energy, especially, has gone down, right? I think it's as simple as that.
No, I think you're right. So that's great stuff there. The other one we wanted to talk about, again, we're just kind of going through some of the recent economic data that we think refutes a lot of the constant barrage of negativity about a coming recession that we've been hearing for about 15 months now. Durable goods. Want to talk about durable goods for a little bit? I know I've got some notes on them. You know them off the top of your head? I know they were stronger than expected.
Durable goods are really strong. You have to think about.
I do have it. Yeah.
Yes.
Here, I'll just jump in. Non-defense capital goods. And that's one that really, that's like CapEx, flow straight to GDP, up 1.4% versus expected down 0.2%. Then the headline durable good number was up 1.1%, expected to be down 1%. They can be sort of volatile, but the overall trend is wildly different when you look at durable goods relative to these surveys from manufacturers, right?
Yeah, no, exactly. And non-defense capital goods, and we are excluding aircrafts here because aircrafts are really volatile. I mean, but there's some good news there because Boeing's getting more orders and things like that, right? So there's a good story. We shouldn't discount aircraft. It's just that because it's volatile, we like looking at non-defense capital goods. What is it? Right. It's basically CapEx, right? Two things. It feeds into GDP, which is a good thing, right? That companies are spending more, they're investing more. But what's the other thing? If they're investing more, that means productivity is probably going to go up over the, in the medium term, in the future. So that's always a good thing. I think we always want to see more CapEx. I think CapEx has sort of been, kind of stagnant for about 2 decades. And we're kind of seeing that hopefully breaking out a little bit, companies starting to invest. Right. We just talked about Apple with virtual reality. And it's hard to get any news right now without the words AI in it, by the way, right?
That's true.
And you think about AI, you think about, by the way, hello, NVIDIA, about 10, 12 days ago, right?
Yeah.
And it's just 6 months back. Not in 6 months back, 3 months back, we were all talking about tech layoffs. Oh no, tech layoffs. Well, now you're talking about AI. I bet tech companies are thinking about hiring more people, not about laying off people anymore.
No, good points there. You think about, I've said this before, but last year, right, all these headwinds, the terrible war, 40-year highs in inflation, most aggressive Fed we've seen in a generation, supply chain issues, China, lockdown, shutdown, start again, lockdown.
Yeah.
This year, we're not seeing those things. Those things are reversing and they're tailwinds. And oh, by the way, now we're getting some good news, right? We're getting new innovations like AI. And no one truly knows how big AI could be. But there's some really smart people who think there's a lot of potential there, obviously. And that's just another tailwind. The final thing, Sonu, because we do need to move forward. And I love this. You share a daily note that we share with our Carson Partners, our advisors, over 350 of them every single day. And you broke down the construction spending and what's really going on there, like on the manufacturing side. Bottom line, and you can take it from here, there's a lot of construction going on, which you'd think probably doesn't mean people are super bearish about this pending world-ending recession we keep hearing about, right?
When we think construction, we usually think of residential construction. And
right.
you and I have talked about that. It's been a massive drag on GDP for about 8 quarters now, right? Continuous. Yep. 8 straight quarters. Residential construction has been a drag. Residential investment, I should say, right? That's, new home sales, all of that stuff, permits, housing starts, whatnot. But you also have non-residential construction. Non-residential construction has been surging up over the last couple of years, right? And basically, it's been driven by this one line item called manufacturing construction. Everyone's talking about a manufacturing recession, but manufacturing construction, which means companies are investing in, factories, things like that, that was up 9% in April, just 1 month, right? 9%. And it's doubled over the last year. 105% since January of 2021 through April 2023, just over 2 years, it's up 156%. What's driving this? Chips and batteries. I mean, I like to think about it as an American renewal, basically, in stuff like this, right? Construction in computers, electronics, electrical industries, right? Basically, semiconductor chips and electric vehicle batteries. That was up 270% over the past year. You see numbers like that in small cap stocks, not in like construction data, right? This is crazy. Right. I think this is one of the biggest stories in America right now. Look, part of it is inflation, obviously, but even if you adjust for inflation, right? You talk about construction spending in real terms, right? You see that surge. I mean, computers, electronics construction is up 233% over the past year after adjusting for prices. And there was a big inflection point last summer. I mean, we talk about debt ceiling and polarization. We've actually had quite a bit of bipartisan bills. I mean, the debt ceiling, was resolved in, I think, a nice bipartisan way. Everyone won something. I think it was a win-win overall, right? I know there was a lot of worry with the debt ceiling, but you and I have talked about, and we talked with Libby as well. We thought the debt ceiling is always going to be raised, well, technically suspended, right? But last summer, we also got the Bipartisan Chips Act. We got the Inflation Reduction Act. I know that was only one party, but a lot of spending a lot of money went from the federal government into manufacturing and, manufacturing of electric vehicle batteries, semiconductors, all of that, right? And I think we're seeing that in the construction data. Again, positive for the economy, positive for America.
No, awesome stuff there. Our friends at Ned Davis Research pointed this out, that small and regional banks hold about 70% of all the outstanding commercial real estate credit. But we've seen an incredible expansion in non-residential construction, like you just talked about. So in other words, virtually no impact in the credit markets, right? These banks are still lending. Things are still happening. And yes, we are aware 3 months from now, 2 months from now, it could change. We've been hearing that for 15 months now. So just, I think, a really interesting concept that not a lot of people are talking about, but you found it and talked about it. And I think it's just so important to point out there are some real positives out there on the economic front, and that's that. And you mentioned one other thing. I mean, you mentioned it, the debt ceiling. I didn't even have it in here to talk about because we didn't want to make too big of a deal about the debt ceiling because we just assumed the whole time it was going to get done at the 11th hour. You can give this like, oh, I'm worried about it. You don't want to worry people. We had Libby on. We talked about. We wrote about it in blogs. We talked about it here on this podcast. But once again, we're going to have another debt ceiling issue in 2 years. Apparently, we're going to say the same thing. We think there's going to be 11th hour of a deal and a punt. All right, so Sonu, this is the most important part of the whole show.
Ryan,
yeah, go ahead. Yep.
The good news, we don't have to worry about it for 2 years. Right.
Yeah.
I think that's positive.
Exactly. So at this point, we're going to talk about the show Succession on HBO, and I'm fully aware not everyone has probably seen it. So what we're going to do is I'm going to tell you when. You're going to hit forward 3 minutes. Sonu and I are going to talk about this for 3 minutes, and I'll tell you when. If you haven't seen the show and you don't want spoilers, hit the button 30, skip 30 seconds 6 times here in a second. All right, so hit that button right now. All right, Sonu, I have a stopwatch started. You and I have 3 minutes to talk about Succession here. I absolutely loved it, but I just wish Shiv would have given it to her brother. I thought I don't know. I thought she was being petty and didn't want to give it to her brother. I get all the dynamics. I get it all. I just wanted a happier ending. Call me old-fashioned. I get the ending. I just wish she would have given it to him and let him have it. But anyway, that's my initial take. What do you think?
I think you said the word there, petty. Mm-hmm. That's literally kind of the definition of the show. Like all these people, like these are not serious people, right?
There it is. These are not serious people. I love you, but you're not serious people. Logan Roy, awesome quote.
These are petty people. I mean, I'm not saying anyone in the market petty. I mean, like for the show, right? These are petty people. I mean, I love the show because it's such a comical farce, right? I mean, these people are running like these massive companies and boardrooms, and they're flying on helicopters for their commutes, things like that. But it was a farce. The whole thing, the farce.
Right.
I mean, I think Roman at the end of it said it nicely, ironically enough. So very profound. This all means nothing. This is nothing. You're nothing.
We're nothing.
I am nothing.
Right.
You're nothing.
He probably used an F-bomb or two in there because that's what the show was. But so we're about halfway done. Amazing how fast 3 minutes goes. I just liked when they were talking about the 100. Remember, they were going to do the 100. Then the 3 siblings were in the room, and like within 10 seconds, they decided, you know what? Let's not do the 100. Let's go after this company Dad wants. Like they were just scatterbrained. They were going all over the place. Totally. They weren't serious people. But you think about it, just that scene when Logan passed away in the airplane, just how they didn't really show what was going on. They were almost showing it to you like from the eyes of the siblings who weren't there, and just the acting. I mean, my goodness, when they did that board vote in the last one, when they're screaming at each other in the room, and he's like, anyway, I mean, it was just like, wow. I mean, just there's so much about that. There's so many. I don't know if it's on a Mount Rushmore of my favorite shows ever, but it is pretty. It's pretty darn close. There. I mean, it is HBO. They just kill it every time. I mean, we've got about 1 more minute. Anything else about Succession you want to talk about in the next minute here?
No, I was talking to my wife. My wife knows how much I love the show, and she was asked. She'd never watched it with me, and she was, "Do you think I like the show?" I was like, normally you wouldn't like business type of stuff, but I think you would like the drama and the comedy aspect of it, and it's almost like tragic comedy, right?
Absolutely, it's a slow motion train wreck. You saw it coming. You saw the slow motion train wreck coming the whole time. Although I did kind of like Tom winning. I was hoping Cousin Greg would. I hope Cousin Greg. They didn't quite. I hope Cousin Greg got in. Tom corrals him. Although I know they had a pretty big blow up there. Literally came to blows hitting each other. I like Tom.
It was
taking
almost
over.
like, and that also like another underline to the show, right? Because I think Shiv calls him like an interchangeable modular part.
Yes.
and he's the one who won out.
5-second warning. 5-second warning. I think we got to stop. Okay.
All right.
Here we go. Good. Sorry. All right. Hopefully you guys have joined us and you just skipped. We probably could have talked about that for 30 minutes. I realized 3 minutes was not nearly enough time. But if you haven't seen Succession, what are you waiting on? Go check. If you like this podcast, the stuff we talk about, of course, we're not quite that extreme. I don't think, but I think you'd love the show Succession. All right, so that was a fun discussion. We're going a little long. Let's talk stocks. Let's talk about that. I'll kind of take a little bit of the lead on this one. By the time people listen to this, who knows? We might be 20% off the October lows. That's a new bull market. I don't like that definition. That's what the media run with. If you listen to this podcast, we've been saying we're in a bull market for a while now. In November, we were saying October was likely the lows of the bear market. We got looked at like we had 3 eyes. It's looking more and more like that. But when you're up 20% off the lows, Sonu, I took a look at the last 13 times that's happened. 1 year later, higher 12 out of 13 times, up 17.7% on average. 3 times, yes, stocks did eventually break those previous lows, twice during a tech bubble, once during a financial crisis. The other 10 were more normal-ish times. Those times weren't very normal. I think it's just another layer on kind of the argument that those October lows are it. and potentially stronger times coming. What else do I have here? Oh, a couple things. So like the global Dow, you can find this real fast on like stockcharts.com, but the global Dow looks at all these different stock markets combined together, just broke out to a 52-week high. The equal weight Triple Q, right? The NASDAQ 100. Hear all about these 5 stocks going up. The equal weight NASDAQ 100 just broke out their 52-week high. The equal weight S&P 500 just broke above a 5-month trend line that was going down, just broke above it. Last Friday, we saw a huge day from small caps, industrials, financials on that realization. Right. Wow, there's no recession coming. I think good news was finally good news on Friday. Sold off a little on Monday. We'll see what happens Tuesday. But I think it's really this broadening out. The story, the theme that I think I'm going to have that I've got in my head for the second half of this year, the bull market continues, but more of a broadening out. Tech did amazing. Communications did amazing. Now we're going to start to see more participation, and industrials, financials, energy's gotten hit hard. Hey, energy, we know what it did the last 2 years, up 50% 2 years in a row. Yes, it's pulled back, but I'll tell you, maybe there could be some opportunity there. What do you think about that idea of broadening out this bull market now versus just tech and communications, although I disagree with that somewhat, but they clearly were the big winners. What do you think?
I mean, last year, the knock on the market was, yes, it was a bear market, but the knock was, if not for energy, things would have been a lot worse. Right. And this year, if not for Apple and Nvidia, things would be a lot worse. Come on. I mean, at some point, like, if you're invested in the S&P 500, do you really care? I mean,
give me the winners. Include the winners.
That's the whole point of it, right? That's why in terms of everyone complains about breadth, and so, and suddenly we got a day like last Friday. I mean, just a date. What was it? June 3rd, was it? June 3rd, right?
I think so. Yeah, well, I put it this way, it was National Donut Day. It was National Donut Day. All I know is it was the first Friday in June, National Donut Day. Whatever day it was, the jobs number was amazing. We had the widest breadth we've ever seen.
Payrolls came out. The S&P was up just under 2%. It broke over. I mean, you and I have been talking about, at least I've been asking you, Ryan, how important is the 4,200 mark, right? And he said, hey, it needs to close above 4,200 for a second week in a row. Boom, it did that on Friday. We're still above 4,200 when I look at my screen. And now this morning on radio, I heard somebody talking about, I want to see it go above 4,300, right? And someone else is talking about, you know what? The last time Apple came out with something big was 2007 when they came out with the iPhone, and then we got a 2-year bear market. I'm like, come on, people, you cannot be serious.
Oh, boy. Yeah, I don't know if Apple's iPhone was the reason we had institutions that lasted for 150 years go under. So some other interesting big picture stats. Our friends at Bespoke took a look at this, and I did also, but I like the way Bespoke did it. They looked at 200-day moving average, long-term trend line of the S&P, made a 52-week high, and now it's pointing higher. I'm sorry, 52-week low. Apologies. The 200-day was going lower, and now it's curled higher. They found 20 times, Sonu, it did something similar 1 year later. S&P higher 20 times. And I forget the number, up 18% on average a year later. That just recently happened. Also, earnings, forward estimates in 2023, forward estimates on earnings have bottomed, started going higher. That tends to be signs, things you see in bull markets. We've been saying we're in a bull market for a while. Now we're seeing broadening out, and these things are doing little to change our overall opinions. I'm trying to think if there's anything else. I created something, what I'm calling the Carson composite.
Right?
And I look at like the third year of a presidential cycle, the third year of a new president, your average year, the past 20 years of the S&P 500, and a year when January gains more than 5%. I smash all those things together in an Excel file, and it computes what the average year using that composite looks like. Well, you know what the average year does in June and July? Pretty strong. Yes, in August, you have a peak and you have that seasonal potential weakness, August, September, October. But to think that we could not have a surprise summer rally when you factor in some of these things that are out there. We haven't got to sentiment. We probably don't have time today. Sentiment is still pretty negative. Look at any tweet I do that's bullish and tell me what you think sentiment is. People just hate it. They hate the idea of stocks going up. I don't know why. I kind of like it. You mentioned go ahead.
No, I was like, you were back in October. I mean, by October, you and I had been working together for about 4 or 5 months or so. And you know, and I think we've been on the same page for the most part, right? But in October, like, even I was like, goodness, Ryan's calling that October 12th the low. It's just a little out there. And then, you know, like I said, we were on the same page. We raised equities to overweight in early to mid-December, right? There's no disagreement there. But I was like, you were like a lone wolf out there saying October 12th was the low, and here we are, right?
Yeah, we talked about on this pod.
Close to 20%.
Yeah, we talked about on this very podcast. October 12th was the day we saw a 5% from low to high, 52-week low, down 2 or 3%, somewhere around there at the open, closed up about 2%, give or take. So like a 5% bounce from the lows. When you make a 52-week low, I pointed it out literally that day and talked about it since. Major market lows tend to take place in it. Remember what happened that day? A CPI number came in hotter than expected. It felt like the end of the world. We're making new lows, everything terrible. Oh my God, inflation's going crazy. And it did, believe me, I'm human too. It did feel like the end of the world. That tends to be that capitulation. And then you saw that big rally off those lows October 12th. And it's been strong since. All right, so I know we've only got a couple minutes to go. So again, we've kind of laid out some bullish points for stocks here, some bullish points on the economy. What was the final thing? I wanted to talk one more thing here. Yeah. So we're going to talk about the Fed. But will you see Jerome Powell this weekend, what he was up to? Did you see where he was during the Fed quiet period? What was he doing this weekend, Sonu?
Like the Grateful Dead and Company. I mean,
Dead and Co. He was at the show on Saturday. Yeah. Someone took his picture on Twitter, and yeah, exactly. I mean, he's got a life. That's kind of cool. He's at the Dead and Company, watching some Grateful Dead, and it's the Fed dead period. A couple weeks before. So I guess he has nothing to do. He can't talk to anybody, so he's going to some concerts. Now, we are running. We only have a couple minutes. Any concert this summer you're particularly looking forward to?
I'm going to two, a Bruce Springsteen in Wrigley Field and a Guns N' Roses. I'm dating myself with both of those, but Guns N' Roses and Wrigley Field too. Mm-hmm. Two concerts in Wrigley for me.
Guns N' Roses, that's pretty cool. So I really liked heavier music as a kid. I really loved Pantera. I'll just say that now. I loved the loud stuff, and they haven't done anything for 20 years. They're touring this summer, so I'm gonna go check out Pantera a couple times. I hopefully will make it to the Motley Crue Def Leppard show again. I want to try and do that. I did it last summer. That was a lot of fun. So those are some I'm looking forward to. So we've got like maybe 2 or 3 minutes, not a ton of time, but there's not I knew there wouldn't be as much to talk about here potentially. The Fed, we're hearing they're going to probably not have a hike in June. They might do one 6 weeks later. Not sure if we buy that or not. I mean, what's your latest take with Fed policy? We're going to wrap things up.
I think when we came, if you rewind at the end of April, right, it came in, the Fed, we knew, the Fed is going to raise rates in May. They did 25 basis points, took rates to about 5%, slightly above that. And then they were like, okay, we're going to pause, right? That's it. Mm-hmm. But then we got a string of strong economic data. We got strong payrolls first week of May. Then we got retail sales, which are strong. We got industrial production that was strong. Housing data was strong. I mean, you and I have been talking through all of this stuff with the podcast. So, hopefully everyone's been listening. And then we got last Friday's payrolls, right? So now things are pretty much, with respect to what Fed policy expectations are, I think investors are all more or less back to where they were, before the SVB crisis. Right? It's as if that whole thing didn't happen. And now we are even talking about maybe one more rate hike. Maybe the Fed's not done yet. But I don't think too many people are talking about rate cuts anymore by the end of the year. I think I think there's like a 50% chance of one rate cut or something like that at most, right? Yeah. So that's gone away. I mean, it just tells you the strength of the economy at the end of the day. And to your point, you said that earlier, good news is finally good news. It's not like last year we were worried about, good data is coming out, so the Fed has to raise rates by 75 basis points. We know they're not going to do that anymore. So I think that's positive.
Good points there. And you and I were chatting just before we started this, right? It was March 16th, 2020 was the first Fed rate hike, I believe 50 basis points. S&P 500 is virtually flat since then. So they increased 500 basis points. S&P is virtually flat. A couple ways to look at that. Yes, there's a vicious bear market in the middle, but there's been a big snapback. So, it's kind of unique to think about, but stocks have really hung in there overall with the 500 basis point hike. Final comment, I mentioned this a few weeks ago, but I'll mention it again. I took a look at the last 10 times the Fed stopped hiking, right? They hiked rates and they stopped. 1 year later, higher 8 out of 10 times. Only 1981 and 2000 were stocks lower after the Fed stopped hiking. And as you and I talked about before, and the average return, I think, is 14% a year later. Where you got to worry is when the Fed starts cutting. Once they start cutting after a series of hikes is when problems happen. You and I have said on this very podcast for months now, they're not cutting. Economy's too strong. We don't see any cuts coming. But if I'm assuming they're done, hey, maybe there's one more coming. But if there is, that might be good because stocks do pretty well 1 year after that last hike. So it's you need to think about. 25
basis points is, within the context of what they've done, 25 basis points more is not going to break things, right? Come on.
Yeah, it's like a half a cherry on top, not even a full cherry on top. And remember when we had Professor Siegel, which, by the way, is still our most downloaded and listened to podcast ever, so thank you for that. When we had Professor Siegel on, I'll never forget it because it was interesting. He said, hey, the stuff the Fed does takes a year, right? They hike rates. That takes a year to get into the system. There's still a lot of medicine coming to kind of combat inflation and potentially slow things down, but we still have a strong labor force, a strong consumer, bringing inflation down. Those are all positive. Sonu, we've hit the end of the road. Any final comments, and I'll bring us home?
No, I am looking forward to the start of the summer. So start of the summer concerts. Chicago's been talking about Taylor Swift being here over the last 3 days. Taylor Swift. I mean, she's like a one-person economic growth engine, machine, whatever, bigger than the Super Bowl, if it. Right. Amazing.
She took over your city. She comes to Cincinnati in a few weeks, and I'll give my Taylor Swift ticket story in a minute. I did sell some for quite a profit, but I'll give that maybe coming down the line. Nice. I bought 6 and I sold 4, and let's just say I made my money. We'll leave it at that. I'll give you details later, but yeah, so that's true. When Taylor Swift's doing what she's doing, how do you have a recession? I will leave it with that. Everyone, this was the 37th episode of Carson's Facts versus Feelings. Bears, you are not serious people. This is a fun one. We appreciate it. We'll be back next week. We're going to be joined. Larry Sprung is going to join us. Is one of our partners, awesome partner here at the Carson.
An awesome book as well. So
yes, so that's going to be a really good one. You're going to like that. If you're an advisor in the industry, you want to learn some tips from one of the very best advisors out there, definitely listen to next week's podcast. But with all that, everybody, this is number 37 is in the books. We'll see you soon. Take care. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.